Hello and welcome to the show. I am Puneet Wadhwa and we have Mr. Ramdev Agarwal, co-founder at Motilal Oswal Financial Services with us today. Hello, Mr. Agarwal. How are you?
Very good. Thank you.
So let me start by asking you, are the investors being given an opportunity of buying their favorite stocks lower amid this geopolitical crisis and they're not realizing it yet?
Yes, I think despite intense selling by global equity markets, more particularly in India by the FIs and all, still the correction has been quite modest. I mean, that has been surprising to everybody that from the top, we're just about 9-10% down, at least at the index level. Some individual stocks must have corrected by 30, 40, 50%. But there is a correction. And I think people who are sitting on the fence a few months back, of course, this wartime was one opportunity. But generally, this kind of war and global disturbances, they used to bring much more kind of correction, deeper correction, 20%, 30%, like what happened in January 2020 when COVID got hit. So straight we got 40% correction. And this time corrections have been much lower thanks to the domestic buying, very strong traction. That has what has kept them. But I think people are, coming out, not very aggressively, but they are selectively buying the, corrected stocks in the portfolio.
So do you think it's time to be greedy or fearful?
No, definitely not fearful. When the world is fearful, you have to be greedy. But how greedy? Because since they are corrected only 10%, so itna bhi kuch antar nahi padta. In the sense that, I mean, yes, you have to. It's a healthy atmosphere for investing. Market has corrected. You are looking at about 19-20 times next year in a peacetime zone. So clearly, these are times to for the stock pickers, and you must start building portfolio. And if you are sitting on the fence, you start getting into the market slowly, 5%, 10%, 15%. You start putting in the market. So that's because nobody knows the future. I'm not saying that I know the future and we can risk, we can price all the risk. But at a price, I mean, and whatever is known, everything is in the price, and it is very resilient. We have seen most of the FI selling. And actually, at one level, entire emerging market has collapsed. So there are 4-5 countries in emerging market. The biggest was China, second was Taiwan, third was India, fourth was I think Russia and Indonesia. Usum say like China, Taiwan, and Russia, 3 are out. I mean, it has become uninvestable by the, capitalist countries like US and Europe and things like that. When they come in, if they want to buy back India again, I think they have to buy India separately instead of buying as the emerging market basket.
But most global frontline indices are near bear territory. Even the Sensex and the Nifty are flirting with it. So isn't there a genuine reason for the investors to worry and panic?
See, all the risk can never be known because it comes from, what is not known is the risk actually. What is known, say inflation and interest rates and Fed action, those are things, yes, they are going to be playing havoc with the valuations and all. But still, those are things which you can somehow fathom. But something like Ukraine, if war actually takes a different direction altogether, this is that the participation increases, the arms supply increases, and confrontation increases. So, and Russia is not willing to take any compromising attitude. So that is not priced in. So, the positions can harden from both sides, and situation can go out of control, and the world will pay in terms of economic prices.
Foreign investors have been selling relentlessly, and the domestic institutions and the retail investors have lent some support. At what point do you think that they will also throw in the towel?
Domestic investors, my sense is that it becomes cheaper. See, if the selling continues relentless, so earning. See, another thing is the pickup in the economy. If the economy picks up, if the war subsides and everything, because see, there were 2-3 big events which happened. One, the elections is behind, and it has happened absolutely for the stable power. Okay, so that gives. So there is a stability in the politics side, which is not a small thing for India. Second, your COVID is completely over. We are done and dusted. So these two have not been celebrated. Clearly, the price of the war has been quite heavy. Now, when you go forward, the war will someday get over in next 1 week or 10 days or whatever, and it becomes a peaceful time, and election is already over. So what will happen is 22-23 looks to be a much better year for the earnings.
When do you think that inflation concerns, geopolitical concerns will start chipping away into the puppet earnings growth for FY23?
Yeah, so what is happening today, if it gets prolonged, see, 15-20 days can always be sustained in the sense that very quickly from $130 oil just come down to say 100. Now it comes down to say 85, 90. That's what earnings were built around. So, I mean, even 85, 90 is not very comfortable number, but I think this is a new normal in terms of you're looking at closer to $100 oil price than 70, 75 kind of a comfortable situation we had. Because another side, USSR is part of OPEC plus, and OPEC is not going to, I mean, they have some kind of alliance forced. So they're not willing to pump too much of extra oil to cool down the oil prices. They are more kind of with Russia in terms of controlling the oil volumes in the marketplace. If the oil is stabilized at 75, 80, 85 in some kind of narrow band, then all the passing through and normal working of the corporates will start. I mean, I'm buying oil as an oil refining company on behalf of customers.
So what is on your shopping list in terms of sectors and stocks? And any contrarian bets?
See, I think wherever the manufacturing is hurt because of this oil crisis, I think that's where the deepest cuts have happened. Like cement companies, oil companies, all the manufacturing companies, they've been cut very deeply. So you have to go and figure out where the cut is going to be permanent, whether the cut is going to be temporary, and how does it, I mean, how essential is the product in the marketplace, and see their assess the impact of the changes right now. So I think that's where some of these things will come because of the FI selling, banks. See, banks and tech, Indian tech, both are doing very well. I don't have any doubt. Both are services, so they're not impacted by the current war impact basically. And both of them were to do well even before COVID. And now it looks that their prospects are intact and they will do well. Now the issue is that has the correction been deep enough for you to find value in them? Definitely in banks, the values are much more visible than in IT. IT has corrected just about 8-10%, but mid-cap IT has corrected a lot more, which can grow at 15-17%, 5-10% higher than or 2x to the big giants like Infosys, TCS. They could grow at about 10-12%, but smaller companies can grow at 18-20%. So the valuation differential was somewhat very high, and there the correction has happened in the mid-cap stocks.
Thank you, Ramdev, for this valuable advice. We hope to see you soon.
Thanks.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.